All right. Hello. Welcome, folks. Tonight, we're going to do a little bit different. So, just reviewing our accounts and some trades. I want to talk to you about volatility and why I think high volatility or high IVR trading is not the answer, even for us premium sellers. Now, I know it's been popularized by Tasty Trade and others out there, and I think they have some really great takeaways, but I am not in support of highly volatile trades and highly volatile underlyings. So I'm going to tell you why here in just a moment and why I try to avoid those and go into a little bit more, I think, lower volatility, safer assets where I can generate consistent returns. That being said, let's jump into it. So, as premium sellers, we're essentially like insurance companies, and we're going to sell insurance to people who think that maybe nothing's going to happen. Okay, we're taking the risk on by selling these options that we could get assigned on the option if the price fluctuates. So, as an insurance company, they're planning on selling the insurance and hoping nobody makes a claim and nothing happens, and they get to keep all of that premium. Okay, great business model, fantastic business model, which is why I think selling options is the way to go. Why not be an insurance company, which can be the most profitable companies on the planet? However, insurance companies do sell insurance in dangerous areas, floodplains and fire areas. And of course, if the numbers do work out, usually they will charge higher premiums to offset potential payouts in those areas. But the catch is that some areas are just so risky that even private insurance companies back off. They don't want to insure coastal Florida, during hurricane season or California's fire zones, things like that. They're not a charity. Insurance companies aren't charities. They're going to take the risk if the price is right. Otherwise, they're going to back off on it. And I think the same has to be true if you're an options seller. Okay? If the risk is right, do it. Okay? But continually trying to generate high premiums by taking on risky assets or insuring homes in very risky areas is a terrible idea, in my opinion. Again, these are my opinions. So, one good example would be back in 1992, Hurricane Andrew in Florida. A natural disaster caused massive losses for insurance companies. Some even went out of business because of it. Okay, big Category 5 hurricane slams into Florida and Louisiana, giant trail of destruction, terrible stuff. Now, at the time, it was the nation's most costliest disaster. It had insured losses of around $16 billion, which in today's terms with inflation would be over $30 billion today. The fallout for insurers was brutal. Many small insurance companies went out of business. American Property Insurance was one of them. They just couldn't cover all of the claims that were coming in. They took on too much risk insuring something in a dangerous area. And when, again, that hurricane hit, which you knew could happen anytime, hurricanes hit Florida multiple times a year. Okay? Not all damaging, not all catastrophic like that, but it can happen multiple times a year. Okay? But these firms underestimated the risk that they were taking of such a catastrophic event happening. Even large firms like State Farm paid out, I think, $3.5 billion worth of claims during that time. Okay, it had to rethink its exposure to all high risk areas. So they changed their entire company model to go after lower risk areas, okay, which is really where you make the most money. Yeah, you can take on some of that risk, but man, if that disaster comes and it wipes out years, okay, billions of dollars for these companies and for you, thousands, tens of thousands of dollars because you took something that was high risk. All right, so let's get into it. I got a little training that we put together for our group, and I'm going to share it with you today. So I'm going to talk about why high volatility isn't the answer. And we totally understand that when you're trading high volatility and high volatility assets, okay, it's a popular strategy. You can collect these great premiums out there, benefiting from high theta decay. That's all good. And as long as things don't get too out of control, you can make some decent money. And there are companies out there and platforms that really emphasize, oh, it's got to be a 30 IVR or higher, and or I'm not going to trade it. Well, let me tell you, I'm going to give you 9 reasons why I think this is a bad idea. So let me share a screen with you, and I'll share some of this training with you. Okay, and then you can decide for yourself. So number one, gamma risk exposure and exploding. So high volatility assets, they have larger and faster price swings, increasing gamma, which is the rate of the change in your deltas. So when you sell options, this can turn even small moves into a massive loss as your position's delta can explode. Okay, it's going to put you in the red fast. Gamma can kill your profits faster than theta can save them. Okay, you don't want to move to go from a zero point 0.2 delta to a zero point 0.8 delta because you have a large move in an asset that's highly volatile. All right, tail risk nightmares. Higher volatility means bigger price swings. Okay, so I love Jim Schultz's every gimme has a gotcha. I'm 100% in favor of that phrase. Okay, so for every good thing, there's some risk or something bad that could happen for you. So high volatility means bigger price swings. Okay, and these assets are prone to extreme unexpected moves because they're volatile. It's highly volatile. You're buying something that's volatile. Okay, do you want to date somebody who's highly volatile and can explode on you at any given time? Or do you want to date somebody who's a lot less volatile, maybe a little less exciting, but it's going to give you a nice, calm, consistent, happy marriage life for a long time? Or do you want someone who can explode and go off the handle at any given time, despite the fact that some of those times it might be fun? Who knows? All right, so the potential for rapid, unpredictable declines can amplify those losses. A sudden spike or drop or gap move can blow through your strikes, can wipe out months of premium in one trade. So you're taking on a lot of tail risk and a lot of risk for that extra premium. And is it that little extra premium, is it worth volatility? I say no. Okay? Everybody will have their opinion. Margin calls. Higher volatility often leads to wider price ranges. Wider price ranges can spike margin requirements for naked options. Okay? So if the market moves against you, then the brokers may want and demand more capital at a time that you can't afford to do it, or you don't want that to happen. So volatility doesn't just hit your P&L as the price moves, it can also strain your account's liquidity if your buying power expands due to that volatility or that asset being volatile and really swinging wildly. All right. Overpriced premiums are mirage here. So let me talk about this. Yeah, high IV means higher premiums, but it also means that higher risk of large moves, as I pointed out. The market prices in bigger moves, so the edge from the theta decay often shrinks when these moves actually happen. Okay? Just like this hurricane. I'm going to insure, okay, the Gulf Coast of Florida as an insurer, and I'm going to charge higher premiums for that. Okay? But oftentimes, those premiums don't offset that loss that you're going to take there. You might have to hope that other trades that you have can generate enough money to offset that one big loss. So again, the extra premium isn't free. Every gimme's got a gotcha. Okay. It's compensating for the higher odds of the option actually going in the money and being volatile. I don't want that. Okay. Maybe I'm a boring trader. Maybe I'm not looking for those 10% returns that other people keep claiming to have a month. I'm just looking for 2% return, maybe 3, maybe less in certain types of accounts that I have. Okay. If that's boring, okay, I don't think 18% a year at 1.5% a month, I don't think that's boring. I don't think 24% a year taking less risk is boring. Anyway, I love money and I love to see consistent increases in my money. All right, assignment risk. Volatile assets also increase the chance of options going in the money, like we said, raising the odds of early assignment. If you're assigned puts or calls early, that can force you to have to buy those shares, okay, and maybe sell other assets to cover those costs. Okay? And you're also getting in at an unfavorable price. I know people say, I love, I'm okay with assignment. Are you really? I'm not. Okay. Yeah, I'll say I'm okay with assignment and I probably could handle assignment. And I do have a plan if that happens. But do you really, really want assignment? Okay. Most people don't. Okay. Oh, but I'm going to trade the wheel. Yeah, so you want an asset to tank so that you can buy it while it's going down, just so you can cap your gains when it reverses. I'm not saying that you can't make money with the wheel. What I'm saying is listen to yourself when it comes to that stuff. And are you really, really okay with that happening? Who knows? All right, but you got to be okay with assignment risk because essentially you're being forced to buy something when volatility is moving against you because you knew it was risky, you did it anyway. Look at you now. Okay, now you own a crappy stock, or you own a good stock at a crappy price, or you own it at a great price because it dropped. Okay, but it's still dropping because it's a volatile asset. Okay, if you're if you're buying and trading quality, and I know these but like the S&P or the QQQ indexes, or maybe even Nvidia or Amazon or Apple, or those, doesn't mean they can't go down, but eventually those assets typically go higher. But they're not high risk. Assets like, oh, let's get into it, SMCI or MicroStrategy or Palantir or some of these assets, these things go up and down and up and down, and they don't always go up in a straight line. If you're in Palantir, you've got a nice 25% loss on your hands if you bought at the top because you thought it would only go up forever. Okay. Just understand you've got highly volatile assets. Why not trade something that's going to consistently give you money over time? All right, emotional stress. Next one here. Managing short options is already stressful. Okay. Having rules, trading your plan, things I advocate, okay, makes it, I think, less stressful. But a position that's comfortably out of the money one day can be deep in the money the next when you trade these volatile, high IV names, okay, which is going to make you have to either panic roll or close at a loss, okay, instead of sticking to your plan. Okay. Some people will roll and they have no idea what they're doing. A roll is taking a loss on a crappy moving asset. Okay. I will do it on a rare occasion, maybe 2% of the time ever will I roll. Okay. And only times I will roll are typically on something like bonds or SPY or QQQ. I'm not doing it on stocks. Okay. Because I don't want something that's moving terribly against me, but it's high quality, good names. So you want to stick to your plan. So for many traders, this is going to cause you panic selling when these big swings have to happen. You don't know what to do. You're going to roll, and it's going to keep going against you. And some people tell you to, roll up the untested side. That's exactly when it reverses. I hate doing that. Oh, then you can go inverted. I hate that even more. And then you can roll out in time to try to outlive this losing asset and give up all the opportunity of putting into new trades that could make you money. You're just trying to break even now. Okay, that makes no sense to me. Anyway, for many traders, okay, this is just not a way to be consistent. And the three things that I talk about are you need patience, you need discipline, and you need consistency. If you have those three things, you'll be a great trader. Well, hard to have discipline on highly volatile assets that are swinging wildly. Hard to be consistent when you're trading high IVR names. Okay. Very hard to be consistent on that because you'd have no idea what's going to go. And patience is tested, okay, because you're trading something that's extraordinarily volatile and you might want to get out of it sooner because it's starting to really move against you quickly. All right, number 7 here. This is a big one for me. This might be top 2. You don't need high IV names to profit from theta decay. You can sell options on stable, low volatility assets, S&P, 500, the QQQ, and other types of indexes like that. I think you can absolutely do great selling theta, selling premium against those names. Okay. And a lot less risk of violent moves on this. Doesn't mean it can't, but a lot less risk of that. Okay. If you rely on high IVR, you're going to be missing tons of trades. And we'll pick that in here. Tons of missed trade opportunities and subpar returns. This is a problem that I see all of the time, especially for new folks that come into our Discord and they sit there and wait and watch me wait and have patience and discipline waiting for my plan. Well, why are you getting into that, now instead of waiting until the IVR is above 30 or some stupid benchmark number? I don't know why. Okay. Because A, I will starve if I wait. Okay? I want to trade the quality assets that I track. Okay. I want to trade SPY and the Qs. I want to trade Amazon and Nvidia, and I want to trade potentially Google and Apple or some of those quality names, but primarily the SPYs and the Qs. Okay. If I wait until IVR gets to 30, I'm going to starve. I'm not going to go chasing crazy ass names because the IVR is at 30, even though it's a piece of junk stock. I don't want something swinging wildly. Okay. So you're missing trades while I'm continuing to put on new trades all of the time in my low IV, stable, steady, consistent names. So I'm making lots of little money, allowing compounding to create massive wealth on my end, as opposed to crazy stuff that's out there. All right, let's keep going. We'll wrap it up for you here with these is liquidity issues too. High volatility assets, especially some niche stocks, can have really thin markets. Wide bid-ask spreads could make it very difficult for you to get out when you need to. This means that you're going to get out at a worse price than you thought, okay? And you're going to have to keep moving your price up because you can't get filled because there's no market there. And now might have a losing trade that you thought was either a small winner and now it's a loser, okay? Or you thought you had a winner, but now it's actually not as good because it's just too thin of a market. I want something that's got plenty of liquidity. Okay. And then the last thing here, it just overcomplicates things. I like simple. I have basic trading rules. I'm pretty mechanical about what I do. I don't get into crazy adjustments. I rarely, if ever, if you were in my Discord for the last 5 years, you would probably never see me adjust a trade. Okay, that doesn't at least have some simple adjustment. Like I said, I'm not rolling up the untested side. I'm not going inverted. I'm not rolling out. I'm not looking at my delta and trying to add more delta to a trade or take delta away from a trade. Okay. I'm just trying to make money there without overcomplicating things. So, in order to have consistency and discipline and not chase the highest premiums, I think you need to trade more low volatility names. I think that's okay. Okay, it's more straightforward. I'm not gambling high stakes here. I want a calm, uh, methodical edge. That's what I'm looking for. Sure, I do trade futures. There's a little bit more risk there, but I'm not trading, again, high IV. Things can happen with anything that you're trading with high IV. So, last thing is you can make a lot of money selling high volatility assets. And some of you will, and some of you will comment, hey, I've been making 10% a year for 6 months. Because you haven't been making it for 10 years. Okay? Most of you not selling premium on high quality assets, or you've at least got some horror story because you traded high volatility assets and you know what? Something spiked, it went against you. So look to take the opportunity to make your trading more consistent, more reliable, take the stress away from your life. Okay. Aim for those 2 to 3% returns. Even 2 to 3% a month is still somewhat risky to take on. It's not a low risk proposition. Okay. But avoid those meme names, crazy names. Stick to the basics. Okay. For me, primarily, I'm trading futures, but I'm trading oil, gas, the S&P 500, and some bonds. That's pretty much it. And I won't trade those if I think the volatility is getting out of control. Okay. How do I know? I typically will look to see what the charts are doing. I'll look at the IV. I don't love it. Okay. I don't love it when they're at 60, 70 IV. I might sell something there. Okay. if it happens to be an underlying that I like that happens to get there, but I'm not seeking that trade specifically. All right. I hope this was helpful. I hope you got some takeaways. You may agree, you may not. It's all good. I'm just sharing you my thoughts on how I like to trade. I like to have that consistency. And I think that if you're just waiting for high IV, you're going to end up in a lot of names you don't like, missing the opportunities to trade those lower IV names that are just going to generate consistent monthly income for you. Have a great rest of your day, folks. If you like this video, click the like button down below. I'd appreciate that. If you're not a member or subscriber on the YouTube, go ahead and click that subscribe button. Join us. Hopefully, I'll give you some content that you can at least get one takeaway from this. And my question for you is, did you get one takeaway from this that you feel is worthwhile, that can help you make yourself a better trader? And if you did, then my job is done. Have a great evening. Bye-bye.